Are you thinking about relocating in retirement? Maybe you're dreaming of better weather, a lower cost of living, or finally being close to your kids and grandkids. Whatever your reason, before you pack your boxes, you need to unpack your numbers. Because the moment you move states, the math behind your retirement plan changes, sometimes drastically. And if you're not planning for it, you could be giving up tens of thousands of dollars to taxes, insurance hikes, and cost of living surprises each year. So today we're breaking down exactly what you can do to shape your retirement numbers when you're thinking about a move. Before we dive in, my name's Ryan Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. So we're going to start with the biggest variable, and that's your state income tax rate. It's tempting to think that when you stop working, your tax bill is going to go down. And in some ways that's true, but your distributions from your 401ks and your IRAs are still going to be counted as ordinary income and therefore taxed. If you move to a high income tax state, you're not just paying federal taxes, but you're paying those high income tax rates on top of that. So let's take an example. Let's say you need $100,000 a year to live off of. And for just sake of this example, we're going to throw out Social Security. We're just going to assume you pull everything from a 401k or an IRA. If you're in the 22% tax bracket, which you should be if you're pulling out $100,000, and you live in a state like Texas or Florida, there's no income tax there. So you would need to withdraw about $128,000, withhold 22% of that for tax, to come up with $100,000 of after-tax money for you to live on. Now imagine if you move to a state like Oregon, where the state income tax rate is nearly 10%. That same $100,000 lifestyle in Oregon would mean you would need to withdraw about $140,000 a year, as opposed to the $128,000 if you lived in an income tax-free state. That's $12,000 a year difference. And over the average 25-year retirement, that's a $300,000 difference in your portfolio value. So now we're starting to see how income tax plays into what your ultimate portfolio value would be at the end of a 25-year period. And it adds up to be quite a scary big number. But state income tax is just one piece of the pie. Social Security can get taxed too, both federally and at the state level. We know that 85% of your Social Security benefits may be taxable by the IRS depending on your provisional income. But if your new home state taxes Social Security like they do in Colorado, Connecticut, or Kansas, that same check might be getting hit again. Same with pensions. Same with capital gains. In some states, even Roth conversions are subject to the state income tax in the year you convert. So if you're thinking of moving from a high state to a no tax state, like from California to Texas, it might make sense to delay your Roth conversions until after your move. Otherwise, you could still be paying thousands of dollars more in unnecessary taxes. But there is a catch. You need to plan the timing appropriately. Most states follow something called the 183-day rule, meaning if you live in a state for more than half the year, they still consider you a resident of that state and they'll tax your income like it. So let's say you move in November and you perform your Roth conversion in December. Even if your new address says Texas, your old state, California in this example, could still send you a bill for the state income tax. Why? Because you technically were still a resident for most of the year in that state. And some states will even go deeper than that. They're going to use things like your utility bills, flight logs, mobile GPS, and Netflix logins to track your actual time spent in a state. So the bottom line, when you move, matters just as much as when you convert the money or make the financial decisions. So document everything. Keep records, file it properly, or you might find yourself paying thousands more in unnecessary taxes. Now let's talk a little bit about cost of living. On paper, moving to a cheaper state sounds like a no-brainer. And for many, it can be a big win. In 2023 alone, 338,000 retirees relocated to low-income tax states like Florida, South Carolina, and Texas. But here's what often gets overlooked. Housing insurance in coastal states like Florida or wildfire-prone zones like California is skyrocketing. Some insurers are pulling out altogether. I've actually seen clients who pay more in insurance than they do in their mortgage because they live in one of these areas. Property taxes also vary widely. In New Jersey, which is the highest property tax state in the country, you'll pay about 2.2%. In Hawaii, it's just 0.3%, and it can vary even more depending on which county of a particular state that you live in. For example, I live in Pennsylvania, specifically in the Pittsburgh area. Some of these surrounding counties don't have a county tax that they assess to your income, but if you live in Allegheny County, which is where Pittsburgh's located, they'll actually assess another extra 1%. So just something to be cognizant of depending on where you plan to live within a specific state and county altogether. There's also sales taxes in places like Washington or Tennessee, which can quietly eat away at your budget, and rent. If you're planning to rent instead of buy, rents have typically climbed at about 3% annually since 2012, even given the big run up during COVID. That $2,000 apartment today could cost you about $2,700 in 10 years. So yes, you can downsize. You may cash out your high value home in, say, California and move to a more affordable state like South Carolina or Texas, but the savings can be wiped out if if you don't account for hidden costs in insurance, HOA fees, utility rates, and inflation. Just other things to think about as you plan your move. Another often overlooked cost is healthcare. Medicare coverage itself may stay the same, but supplemental coverage, out-of-pocket expenses, and access to providers can vary dramatically by region. Let's say your Medigap policy doesn't cover your new zip code, or the specialists you need have long waiting lists in your new town. Suddenly, the system that you were used to using is no longer working for you. Not to mention, long-term care costs fluctuate dramatically by state. A long-term care facility in the Midwest is typically much cheaper than one on either of the coasts. A private room in a nursing facility can cost as much as $100,000 per year in some places, and less than half of that in others. Just other costs that you need to be aware of as you think through your relocation strategy. And then there's your estate plan to think about. Some states have inheritance taxes, others don't. Some tax your estate even if the federal government doesn't. New York is a great example of that. The beachfront condo you bought for your golden years? Well, if you didn't plan ahead, your heirs could face unexpected probate or estate tax hurdles simply because of where it's located. In Pennsylvania, which is one of the highest inheritance tax states, spouses have the ability to inherit tax-free from their deceased spouse, but kids and grandkids over the age of 21 are taxed 4.5% on their inheritance, siblings 12%, and anyone else is 15%. So if you have a favorite nephew, Johnny, and he inherits $100,000 from you, he's only receiving $85,000 of that. As opposed to your kids or grandkids, that same $100,000 to them is worth $95,500. So who you're giving your money to matters depending on where you live. And it's very important to think through your estate tax picture at the state level, because I've seen clients shocked by how much their state takes off of the top of what they built. And there's nothing worse than knowing that there's a huge bill waiting for your loved ones at the end of your life simply because you chose to live in the incorrect state for your estate planning needs. Okay, so far this might sound like I'm trying to talk you out of moving in retirement, but I promise you I'm not. Relocation in retirement can be a smart, fulfilling move, especially if you've run the numbers and aligned your financial plan accordingly. So here's a checklist of all the things you can do to do it right. 1. Know your full tax picture. Income, property, sales, capital gains, Social Security, and estate taxes are paramount to understand before you make a move. Understand your residency status next, and how your former state might try to tax you. 3rd, map out a forward-looking tax strategy, especially for Roth conversions and asset sales. 4th, review your insurance costs, including home, health, property, long-term care insurance. Next, you want to evaluate your lifestyle shifts, how family dynamics, community, travel costs, and daily spending might change. 6, consider testing the move. Rent for a short period before you buy in the area which you want to move to long-term, just to see if it's a fit. 7th, and most importantly, get professional help. And I'm not just talking about a CPA, but someone who can project your future cash flow and tax burden for the next 20, 30 years of your retirement. That is the most important and most crucial step that you can take before you make your move. Now, retirement isn't just about returns. It's about the net. It's not about what you earn. It's about what you keep. And where you live plays a huge role in how much you get to keep. So before you book the movers, book a meeting. Let's look at the numbers. Let's run the scenarios. And let's make sure your new chapter comes with a plan that protects your time, your money, and your peace of mind. Because in retirement, you don't need more stress. You need a smarter plan.